Hi everyone, this is Nancy Godrat, and in this session I'm going to go over objective number 2 of, and hopefully number 3 as well, of chapter 9. Objective 2 is discussing depreciation. What is depreciation? Uh, it's a process that we take the cost of the plant asset, except land, because land cannot be depreciated according to GAAP, since we're always going to have that land, that dirt, to do whatever we want with it. So depreciation is allocating the cost of that plant asset over its useful life in a rational and systematic manner. Now, depreciation is an expense. And then we will show what would be the journal entry. First of all, in this process, we're trying to allocate the original cost, not the fact that we are coming up with the market value or valuation of the asset. So it applies to land improvements, building and equipment, but not land. Now, depreciable, it's depreciable because these assets produce revenue, and as we're using them, their efficiency of producing more revenue will go down over the asset's useful life. Think about a truck or a car. As it gets older, it might not be able to run more efficiently, and therefore eventually we have to get rid of it, sell it, or replace it with another car or equipment. However, during the life of the asset, we have to allocate the original cost of the asset that we paid, plus all the other expenditures that were included in the cost, over its useful life of the asset. Now, the useful life of an asset is an estimate because we really don't know upfront how many years this asset will be useful. So how do we come up with that estimate? It's based on prior year history of how long this type of asset has been useful, or it could be based on a policy that the company has. Sometimes the policy might be that every 5 years they replace their trucks or cars. Why? Because after 5 years and the high mileage, they might not have efficiency. The cost of repair and maintenance might be higher than it is worth keeping them. So it is okay to use estimates in accounting as long as they are reasonable. Now, the other thing we need to make an estimate is that at the end of the useful life, are we able to sell that asset for any amount? Again, this is an estimate because we don't know what happens at the end of useful life and how much we can sell it, if any at all. So sometimes the salvage value is 0, and sometimes it's given to you in homework or exam question. The other name for salvage value is residual value, what is left as far as the cost of the asset that we can sell at the end of its useful life, or sometimes during its useful life. How do we record the depreciation? We're going to debit an expense, which is reported in income statement against the revenue for that year. Instead of crediting the asset directly, because the cost principle says you cannot touch the cost of the asset until you get rid of it, we're going to come up with a new account called accumulated depreciation. And if you remember from chapter 3, accumulated depreciation is a contra asset. It's opposite the equipment. So the normal balance is credit, meaning we debit depreciation expense and credit accumulated depreciation for that asset, and we show it on the balance sheet after the asset's cost as a deduction from the cost of the asset to arrive add unused portion of the cost of the asset, which is called book value, the value of asset in our books. Now, there are different types of depreciation methods, at least 3 that are discussed in chapter. And straight line method, you will see a straight line method from this pie chart is used more frequently in practice in real life than the other methods. So therefore, we're going to cover straight line method in this chapter, and you're not responsible for the other 2, units of activity method and declining balance method. They are beyond our class and will be discussed in a more advanced accounting class. Again, there are materials about these 2 methods and how they are used in this chapter, but you're not responsible for them. And there are no homework question or exam question regarding those 2 methods. Now, how do we do the straight line depreciation? So let's say our company, which is a florist company, purchased a delivery truck on January 1st, 2017. By the way, these dates that they purchase is very important when we calculate depreciation. Now, the cost of the asset is $13,000. We have an estimated salvage value of $1,000 and useful life of 5 years. Now, the useful life in miles, do not worry about it because that's used when we use a different method of depreciation. So you're going to only use the first 3 items to calculate the straight line depreciation for this asset. Now, a straight line depreciation has a formula which you need to know. Cost of the asset minus salvage value is called depreciable cost, meaning that's the amount that we can actually expense over the useful life of the asset. Why? Because the salvage value, we're estimating that we're going to get back in form of cash at the end of useful life. Once you have the depreciable cost, you're going to divide it by its useful life, and what you arrive at is the depreciation expense for each year until the useful life is finished. So for example, by the way, we can look at the rate as 1 divided by useful life, always 1 in the numerator and useful life in the denominator. That's called the rate of the depreciation. So in this case, 12,000 depreciation cost times 20%, which is 1 over 5. 1 over useful life. Again, 1 always is in the numerator and useful life in the denominator. Therefore, the annual depreciation is $2,400. And that's the total annual depreciation for the first year because we bought it on January 1st. If we would have bought it at any other date in the middle of the year, then the amount of depreciation for the first year would be a fraction of the $2,400. How do we arrive at that? Let's say we bought it on July 1st. Then we can only take half of $2,400 as an expense during the first year of useful life of this asset, because there are only 6 months in 2017 that we used it in the operation. Now, the journal entry would be debit to depreciation expense for $2,400 and credit to accumulated depreciation for $2,400. So therefore, the book value, how much of the asset has not been used as of the end of 2017, is the cost minus, not the depreciable cost, the cost minus the depreciation expense or accumulated depreciation, actually accumulated depreciation. So that's called book value. The second year, the cost is the same, and the third year, the cost is the same. So each year we're making the same journal entry, but as you see, the book value is going down. Now, the last year of the operation, the book value becomes the salvage value, the amount that we cannot depreciate because we're expecting to get back. So the journal entry each year would be the same journal entry. Depreciation expense debited, accumulated depreciation is credited. However, the book value in the balance sheet always will show as cost minus accumulated depreciation. So accumulated depreciation, for example, at the end of 2018 is the addition of 2,400 and 4,800. So it's going to be 7,200. Now, let's look at an example. Iron Mountain Ski, again on January 1st, 2017, they are buying a machine for $50,000. The machine is estimated to have a useful life of 10 years and a $2,000 salvage value. So first, we're going to come up with the depreciable cost, which is the difference between the cost and salvage value. Once we have that, we're going to divide it by the useful life. And that would be annual depreciation. So you can multiply it by 1/10 or divide it by 10. Now, what methods can we use for income tax? For income tax, you can use a straight line method. Also, there is another method that is acceptable under IRS rules, Internal Revenue Service rules, and that's called MACRS, or Modified Accelerated Cost Recovery System. And the concept is that we're going to take more depreciation at the beginning of the life of the equipment or asset, the plant asset, because it's more useful, it's more efficient. And as it gets older, the amount of depreciation decreases. Remember that MACRS is only used for tax purposes, is not acceptable under GAAP. Under GAAP, the 3 depreciation methods that you saw are acceptable. Now, we're not going to go over revising depreciation when in the middle of the life of the asset we realize we want to use a different useful life or a different salvage value or both. It is not covered in this class, and there's going to be no question in homework or